Ever wondered how the Oracle of Omaha sees a market crash coming before everyone else? Warren Buffett's warning signals have predicted some of the biggest market downturns in history. What if I told you that this prediction method isn't some complex algorithm or insider information, but a simple indicator that anyone can use? In this video, I'll show you the exact market indicator Warren Buffett uses to predict when stocks are overvalued and ready for a fall. I'll break down how this indicator has successfully predicted every major market crash in the last century, including the 2008 financial crisis and the dot-com bubble. And at the end, I'll show you what this indicator is telling us about today's market and how Harry can potentially protect his $100,000 portfolio from the next crash. Here's the thing about market crashes. They're inevitable but unpredictable for most investors. While everyone scrambles to time the market, most fail miserably. Even professional fund managers with advanced degrees and sophisticated models can't consistently predict market turns. That's why Warren Buffett investment advice stands the test of time. Instead of trying to predict exact market tops and bottoms, Buffett uses a fundamental valuation metric to gauge when the market is dangerously overvalued. Consider this. During the 2000 dot-com crash, the S&P 500 plunged 9.1%, while Berkshire Hathaway's share price rose about 26.6%. That's a 35.7% outperformance. How did Warren Buffett investing strategy achieve this? By understanding when the market was irrationally exuberant and positioning accordingly. The Buffett Indicator. Explained. The solution to this market timing problem isn't market timing at all. It's valuation awareness. Enter what's now famously called the Warren Buffett Indicator, simply the total market capitalization divided by GDP. This elegantly simple ratio shows whether the entire stock market is overvalued or undervalued relative to the size of the economy. Buffett himself once called this probably the best single measure of where valuations stand at any given moment. Here's how it works. When the total value of all publicly traded companies significantly exceeds the country's GDP, stocks are likely overvalued. When it falls below GDP, stocks may be undervalued. What makes this indicator powerful is its track record. Just before the 2000 dot-com crash, this ratio hit a then-record high of 148%. Before the 2008 financial crisis, it climbed to 137%. Both times, Warren Buffett's cash position increased dramatically before the crash, showing his confidence in the indicator. How Buffett uses this indicator. Warren Buffett investment strategy doesn't stop at just identifying overvaluation. He takes specific actions based on what his indicator tells him. Let's break down his playbook. First, when the indicator signals extreme overvaluation, Buffett builds cash. During 2019 to 2021, Berkshire's cash hoard swelled to over $100 billion because Buffett found few stocks priced attractively. This wasn't mere coincidence. The Buffett indicator was blinking red. Second, he becomes extremely selective. Rather than completely exiting the market, Warren Buffett stock selections become much more conservative, focusing on companies with strong balance sheets, consistent cash flows, and durable competitive advantages, what he calls moats. Third, he prepares to be opportunistic. All that cash isn't just sitting idle, it's ammunition for when the crash eventually comes. When everyone else is forced to sell, Buffett starts buying. During the 2008 financial crisis, while markets were in free fall, Buffett invested $5 billion in Goldman Sachs, a deal that ultimately generated billions in profit. Let's look at how Harry, with his $100,000 portfolio, might apply this approach. If Harry notices the Buffett indicator reaching extreme levels, he might move 30 to 40% of his portfolio to cash focus, remaining investments on companies with strong balance sheets and essential products. Prepare a watch list of great businesses to buy when they inevitably go on sale. Historical proof of the indicator's effectiveness. Warren Buffett's investment advice about market valuation has proven remarkably effective through multiple market cycles. Let's examine the historical proof. During the late 1990s dot-com bubble, while technology stocks soared to unsustainable valuations, Buffett largely avoided tech stocks, sticking to his circle of competence. This decision initially cost Berkshire. The company actually underperformed in 1999, declining 19.9%, while the S&P 500 rose 21%. Critics said Warren Buffett's age had made him out of touch with new tech realities. They claimed he just didn't get internet stocks. But then the bubble burst. Over 2000 to 2002, while tech stocks and the broader market crashed, Berkshire outperformed significantly. The 2008 financial crisis provides another perfect example. As the crisis unfolded and the S&P 500 plunged 37%, Berkshire fell too, but only by 31.8%. More importantly, Buffett's cash stockpile allowed him to make exceptional deals at the bottom, when Goldman Sachs and General Electric desperately needed capital. If you're finding value in understanding how this market indicator works, hit that like button. It really helps the algorithm show this video to more investors who could benefit from this knowledge. Current indicator. Reading and what it means. So where does the Warren Buffett indicator stand today? As of early 2023, the total U.S. market capitalization to GDP ratio stood at approximately 150 to 170%. Precise numbers vary based on calculation methods. Historically, the ratio has averaged around 80%, with readings above 115% suggesting overvaluation and readings below 50% suggesting undervaluation. At 150 to 170%, we're well into overvalued territory, similar to levels seen before previous major market corrections. What does this mean for your investments? Well, Warren Buffett's cash position tells us something important. Berkshire Hathaway has been holding record amounts of cash, over $147 billion as of recent reports. That's extraordinary cash restraint in a high inflation environment, suggesting Buffett sees significant market risk. Let's see what this could mean for Harry's $100,000 portfolio. If Harry follows historical patterns, he might expect a 30 to 50% market correction from these valuation levels. That could mean his portfolio dropping to $50,000 to $70,000 if fully invested in stocks. But by applying Warren Buffett's investment advice and raising cash while being selective with remaining investments, Harry could position himself to not only avoid the worst of the decline but potentially profit from it by buying excellent businesses at bargain prices when others are fearful. Long-term investment projections following Buffett's approach. Let's look at the long-term impact of applying the Buffett indicator to Harry's investment approach with specific projections. Scenario 1. Harry ignores valuation warnings, stays fully invested, starting with $100,000, if Harry experiences a 40% market correction followed by average historical returns. After 5 years, $103,512, barely recovered initial investment. After 10 years, $169,716. After 20 years, $456,381. After 30 years, $1,226,907. Scenario 2. Harry follows the Buffett indicator, raises 40% cash before correction. Harry's portfolio initially becomes $60,000 stocks plus $40,000 cash. During the correction, stocks drop to $36,000, but Harry deploys cash at lower prices. After 5 years, $131,489, 27% better than Scenario 1. After 10 years, $215,443, 27% better. After 20 years, $579,591, 27% better. After 30 years, $1,558,172, 27% better. These projections show that just one cycle of correctly using the Buffett indicator can boost lifetime returns by over 27%. And that's assuming Harry only gets it right once. Warren Buffett's investment strategy of being fearful when others are greedy compounds dramatically over time. What's even more striking is that Berkshire Hathaway has achieved approximately 19.8% compounded annual returns over 58 years compared to the S&P 500's roughly 10%, nearly double the market's return. This performance gap isn't just from stock picking, but from Buffett's exceptional market timing using valuation principles. If this long-term perspective has been helpful, please consider sharing this video with a friend who might be worried about current market conditions. Knowledge is power, especially in uncertain markets. How to incorporate the Buffett indicator into your strategy. Now let's discuss practical ways to incorporate the Warren Buffett indicator into your investment approach. First, regularly monitor the indicator. You can easily track it through websites like currentmarketvaluation.com or Guru Focus, which update the ratio regularly. Second, set your own action thresholds. While Buffett hasn't published specific thresholds, historical data suggests below 80%, market potentially undervalued, consider increasing equity exposure 80 to 115%, fairly valued. Maintain normal allocations. 115 to 140%, moderately overvalued. Increase selectivity, begin building cash. Above 140%, significantly overvalued. High cash position, extreme selectivity. Third, adjust gradually, not suddenly. Even when the indicator reaches extreme levels, don't panic sell everything. Warren Buffett selling stocks happens methodically, not in a rush. Fourth, prepare your shopping list. Identify great businesses you want to own and the prices at which they'd be attractive. When the market eventually corrects, you'll be ready with both cash and clarity. Fifth, remember this is just one tool. Combine it with other valuation metrics like the Shiller P/E ratio or dividend yields for confirmation. Remember that Warren Buffett's investment advice isn't about avoiding stocks altogether. It's about being price-conscious and patient. Even at market highs, he continues holding excellent businesses for the long term. The Warren Buffett Indicator gives ordinary investors a powerful tool to gauge market risk and opportunity. While it can't predict exact timing of corrections, it provides crucial perspective on market valuation that has served Buffett well through numerous market cycles. Remember Buffett's famous advice: be fearful when others are greedy, and greedy when others are fearful. The market cap to GDP ratio helps identify when greed has pushed valuations to dangerous levels and when fear has created rare buying opportunities. As we've seen, following this approach could potentially help Harry transform his $100,000 portfolio into over $1.5 million over 30 years, outperforming a buy-and-hold strategy by hundreds of thousands of dollars. I hope this breakdown of Warren Buffett's warning signals has given you valuable perspective on current market conditions and how to position yourself wisely. If you found this analysis helpful, please subscribe for more content on value investing and market wisdom. I release new videos every week breaking down timeless investing principles. What's your take on current market valuations? Do you think we're headed for a correction, or is this time different? Share your thoughts in the comments below, and I'll see you in the next video.